Hello and welcome to the BDO not-for-profit webinar, getting ready for 30 June 2022. We do hold these every 6 months and it seems to come around quite quickly. So once again, we're here to share some very relevant information with you. Aletta will be presenting the technical component of the webinar today, so welcome Aletta. And obviously Aletta's very skilled at what sometimes can be dry topics and making them interesting to listen to at least. So really looking forward to what you're going to go through today, Aletta. Following the technical part of the presentation, we do have a panel that will then join us at the end to talk about observations of what we're seeing in the not-for-profit sector and some further tips on getting ready for the 30 June 22 reporting season. So Elizabeth Blunt, a partner in the audit partner in the Melbourne office, will be joining us. Leah Russell, an audit partner in the Sydney office, and both of those audit partners are not-for-profit specialists. They service a lot of clients in the not-for-profit space. Ashley Bleeker will be joining us, and those who have been on these webinars before have probably seen Ashley before and talking about corporate reporting and ESG, which amongst the audit committees that I attend, that ESG and what does it mean for not-for-profits and the opportunities in it is getting a lot of discussion. So it's great to have Ashley here. And then Oliver Streeker from the private wealth side of the business in Brisbane here will be joining us to talk about aspects around investments, which I know a lot of not-for-profits do have investments, and they're always keen to understand where to put their money. And if you watched Four Corners during the week, you wouldn't be putting it in cryptocurrency at the moment, so I don't think you'll be recommending that. Okay, so that's where we're going today. Aletta, I'll pass over to you.
Thank you very much, Anthony. I'm super excited to do the webinar with you and a number of panel members. Usually this is a very lonesome affair, so lovely to have everybody here. And it's a cold and chilly day here in Melbourne. I hope you are all safe and well and somewhere warm. So I thought I'll start by talking about, so where can not-for-profits find information to assist them with their 30 June 2022 reporting? So you've attended the webinar, but you want to read more, or you want some additional information, something in particular was of interest to you. So I'll flick through a few pieces of information that's available. First of all, Chartered Accountants Australia New Zealand have in November last year issued an update of their not-for-profit guide, or a new not-for-profit guide. And it's enhancing not-for-profit and charity reporting, and part A specifically focuses more on the sustainability, ESG, etc. reporting. BDO was really proud to author part A of this guide, so there's some interesting stuff there. There's 3 parts to it. Part B is looking at enhancing financial reporting for Australia, and then also enhancing financial reporting in New Zealand. So I've given you links to these guides. It's got amazing information in there around requirements in the different states in Australia, etc. So a very useful guide that's available on Chartered Accountants Australia New Zealand website. So I thought, great publication, please look at that. At BDO, not-for-profits are really important to us, and Anthony is our national leader of not-for-profits. And therefore, in our monthly corporate reporting insights, which is our monthly newsletter, we have a dedicated section for not-for-profit entities. And every month we have an article in there flagging what we're hearing, what are the issues being faced by not-for-profits. So I've put in a link to our publication. You can register to receive this publication every month. but we also post those articles on our website and we put it on LinkedIn as well. The other thing we do is we've got monthly webinars, IFRS and corporate reporting webinars, and the stuff we discuss here, accounting standards, impact for-profits and not-for-profits. So this webinar is actually in addition to the monthly webinars we do, and this webinar is focused on very specific not-for-profit issues. So we're not repeating what we're doing in our normal IFRS and corporate reporting webinars. So please feel free to watch recordings or to register to watch upcoming webinars. And now we've been doing this now for around 5.5 years. So there's 5.5 years of recordings available on so many topics that would be of interest. And I know we've got on AASB 1058 and AASB 15, for example. This year, Ashley Bleeker and I have introduced another series. It was a 6-month series only around sustainability and ESG. I think we more or less halfway through the series, so there's 3 left. You can watch the recordings. But everybody's talking about sustainability. We've seen it's been a big election issue around climate change as well. And we talk about the broader environment, social and governance. So if you want to look at that, I think that would be amazing, and it applies to not-for-profits and for-profits. So please feel free to register. The other place where you can find information is BDO have a web page dedicated, or a number of pages dedicated to not-for-profits. So there's a BDO not-for-profit industry website where we share information that we think would be of relevance to not-for-profits, accounting and otherwise. So it could be various other things, whether it's tax, whether it's FBT, whether it's wage compliance, everything is there. We also have a section in our IFRS and corporate reporting website, obviously talking about all the accounting standards, including the aspects that apply to not-for-profits. We have recently released a new part to our IFRS and corporate reporting section, and that is we've decided to group together all our materials, articles, global materials, webinars, IFRS decisions, training materials, and put it on our website per topic. I think clients have maybe found it a bit hard to get access to it, to know where it is. It's always been on the website, but where? How can I get to that leases information quickly? So this is a screenshot of the topic page for leases, but there's a topic page for every topic. And you can go straight there and you can find everything we've got available, and you won't believe what we've got available on every topic. It's all to make it easier for you to access these materials. We've also launched a training hub, and in our training hub, we've got obviously the free monthly webinars, not-for-profits, ESG, IFRS, etc. A lot of webinars, and we keep it all there. We also have seminars that's been recorded on most accounting standards, including case studies and solutions to case studies. And we've got e-learning, and there's some amazing e-learning that our guys have developed around the accounting standards, where you can test yourself if that's your learning style. So we're trying to address all learning styles, whether you like reading, I like reading, whether you like watching, whether you want to have interaction, etc. It's all there. So there's a lot of material available. So the e-learning programs, this is what the page looks like. The e-learning is behind a pay gate. Most of the other materials, I would say all the other materials, are free of charge on the website. The e-learning behind a pay gate. So that is where can you find additional information for you and your team. So your team can attend all of these webinars to upskill themselves, stay up to date. The webinars, you get attendee certificates, etc. Going on to the agenda today, what's new for not-for-profits? So we start first of all with the most important thing, the financial reporting framework and the new AASB 1060. Then we look at amendments to the ACNC regulations. We look at the best practice guide issued by the ACNC. Some amazing news for not-for-profits around Peppercorn leases. So, you know, listen for that one. We look at portable long service leave. We then touch on ESG and sustainability. We do flag with you some upcoming changes to IAS 1 on how do we classify our liabilities as current or non-current, which is a big issue. And then finally, it's just a reminder that if you're a director of a not-for-profit entity, there are some director ID requirements, which is a new requirement, and we provide a reminder and a bit of deadlines by when you have to register. So that's a quick overview of what we'll be discussing in the first part of the webinar before we get to the panel discussion. So I'll fly right into it. So if we look at the financial reporting framework and new AASB 1060, so all of you would be aware that for for-profits, 30 June 2022 reporting is a big change because all our for-profits that lodge with ASIC have to prepare general purpose financials. There's a big move away from special purpose to general purpose in the for-profit world. The good news for not-for-profits is we're not there yet. It's still the old regime. So if you look at 30 June 2022, you would still say the key question is the not-for-profit entity a reporting entity as defined in SAC 1, Statement of Accounting Concepts 1? If you are a reporting entity, you have to prepare general purpose financials, and that could be tier 1 or tier 2, and it's quite often tier 2. So that assessment is the same that you've done for how many years? Forever and a day. If you're not a reporting entity, you can voluntarily prepare general purpose financials, or you can prepare special purpose financials. Important to note that this assessment, whether the not-for-profit is a reporting entity or not, is a self-assessment. It's been problematic, and that's why this self-assessment has been removed for for-profits. We're expecting it to be removed for not-for-profits. It will take another year or 2 or 3, we're not sure, but there's a process in place. The AASB is looking at it, the ACNC is looking at it, but you don't have to change yet. And I would actually recommend that you don't change at this stage. Let's see what the final recommendations are. And the reason I'm saying that is the AASB is also looking at a position where if, and this is a if we say a not-for-profit have to prepare general purpose financial statements, for example, because they're lodging with the ACNC, which is a public record, maybe those general purpose financial statements don't only have to be tier 1 or tier 2. The AASB is thinking about introducing a tier 3 general purpose financial statements, and they are working through what the detailed requirements for those tier 3 general purpose financial statements might look like. So I'm part of a panel, a project advisory panel where we're working through that. So I'm thinking it's a good time to just wait and see what happens. So if you've been doing certain things for many, many years, I would stick with that. You know, if you had an assessment around reporting entity, you know, stick with that. Obviously, unless your facts and circumstances have changed drastically in the current year, but that would be my thinking. I have included a link there right at the top, which is a link to the ACNC website, where they give some guidance on SAC 1, some guidance to help you to assess whether you're a reporting entity or not. It's been there for a long time, but I just wanted to remind you of that. So currently, for 30 June 2022, you have to consider, self-assess, are you a reporting entity or not? And that will then determine whether you have to prepare general purpose financial statements or not. However, you know, the next question, once you know whether you do general purpose or special purpose, is so which accounting standards should be applied? Now, clearly, if it's general purpose financial statements, you have to do all the accounting standards. Tier 1, recognition and measurement of all the accounting standards. Tier 1, all the disclosures. And Tier 2, before the current year, Tier 2 would have done all the recognition and measurement, but they would have done reduced disclosure requirements, RDR. Please note, and this is a change, for 30 June 2022, RDR no longer exists. Therefore, if you are preparing general purpose financial statements and you're in Tier 2, you will have to change to AASB 1060 simplified disclosures. So that's the only mandatory thing I would say that is happening within the regulatory framework world. If you are not a reporting entity and you are preparing special purpose financial statements, you have to comply with, as a minimum, 5 accounting standards, which are AASB 101, AASB 107, 108, 1048 and 1054. So basically, presentation of financials, a cash flow statement and accounting policies, etc. I've put in red there. You should also consider the application of AASB 124, related party disclosures, and I'll talk about that a bit later, because for 30 June 2022, AASB 124 would be mandatory for large charities, and the year after for other charities as well. So we'll look at that. And then the other thing that's interesting is the ACNC have said, if you're preparing special purpose financial statements and you want to apply the disclosures in AASB 1060, which usually is only available if you do general purpose financial statements, you can look at AASB 1060 disclosures. And I think what we're seeing here is everybody is trying to encourage not-for-profits to move to general purpose, to move to AASB 1060. And if you want to do certain things on a voluntary basis to get ready for that new regime, they will allow you to do that. And I'll come back to that point a bit later as well. So I think this is a really good overview of our current position. So please, special purpose financials, the 5 standard as a minimum, consider 124, consider 1060.
Aletta, just before we leave this, and that's a good overview of that. With the numerous not-for-profits that I do the audit of, I suppose make the observation, a lot of them already do general purpose financial reports, and they all adopt the reduced disclosure requirements. So obviously with the move to 1060 this year, they'll need to be considering what's changed, and I think we might touch on it a little later, but it's probably worth saying at this point, there's really not a lot, or not any significant changes, I think, between the 1060 and RDR, is there?
Yeah, I think the one thing to maybe look at, and it's usually a sensitive one, is around disclosures around key management personnel related parties. I don't think it's significantly different, but I would just double check that to make sure if I'm a not-for-profit. So this is what I've done under RDR. Under 1060, it might be slightly different. Have I complied with every aspect? But I think you're right. At a big picture level, not a great deal of difference.
Yeah.
I think the other thing that goes with that is if a not-for-profit is currently preparing special purpose, we're not recommending that you move to general purpose now. You know, if you're not a reporting entity, you're not a reporting entity, you do what you do, wait for the framework to be finalized. However, there's been a new standard, AASB 1055/9 that specifically says, if you're doing special purpose, tell us how you're preparing it. So tell us which accounting standards you're doing the recognition and measurement of and which not. And in particular, tell us about consolidations, tell us about your group structure, because that's often a bit of a sticky point when you go from special purpose to general purpose. So there's a need to be very transparent on what you're doing in your special purpose financial statements. And again, it's kind of encouraging people to start to think about the transition to general purpose financials if you're not there yet. Then the next section, I'll give you a bit of an overview on amendments to the ACNC regulations. So the first thing is for 30 June reporting period, we know there's an increase in the size thresholds. So I think this is the other interesting point. From an accounting perspective, when we talk about general purpose financials, we talk about tier 1, 2, and 3. But when you get to the ACNC, they also have 3 different tiers, and they talk about small, medium, large. So not to be confused with the 3 tiers that I'm talking about within general purpose financials, this is a different thing. This is a size threshold to know what your responsibilities are with the ACNC. So small will now be when your revenue is less than $500,000, and then you don't need an audit or review. If you're medium, it's between $500,000 and $3 million revenue. You need a review or an audit. And large will now be not when your revenue is over $1 million, but if your revenue is over $3 million, and then you would need an audit. So I've included a link to the new regulations. Now, you can see your size is determined by your revenue number, and that then has a flow-on effect on whether you need a review or an audit, etc. Therefore, determining a revenue is actually quite important.
Aletta, just before we go into the, sorry to interrupt, and I know technology doesn't work great for interruptions, so I'm sorry about that. Just before we go into the revenue piece, probably just worth mentioning that depending on the type of organisation that the charity is, that can also influence obviously your financial reporting requirements. So here in particular, I'm thinking of associations. So generally charities will either be companies limited by guarantee or associations. They make up the bulk of it. Now, associations are governed by the relevant state legislation, and a number of the states have made changes over the last few years to align the financial reporting requirements with the ACNC regulations. So what you probably would have seen when ACNC first came into place, for those associations, their accounts would refer to prepared in accordance with the ACNC Act and also the relevant Association Act. Now, not all states have made those changes, and Queensland is one that isn't quite there yet. They've put out the legislation and passed the bill to make it so that association financial reporting requirements are in line with the ACNC regulations, but that's still waiting on proclamation by the government. Now, looking at the government website again this morning, they're still saying that should be in place by 30 June 2022, but they've been saying that, I think, for the last 12 months or more. So it's just important to be clear on that. And then, so for example, for a Queensland association, it's if your revenue is more than 20,000, then you need to have your accounts audited. So it is quite different.
Correct. So thank you very much for that, Anthony. I really appreciate that. I've just been looking at the ACNC regulations, but you're 100% sure that different states have different regulations. And I think that is actually something that is picked up in that Chartered Accountant's Guide. And there's a summary of the rules for the different states. So that's a good place to get a nice summary of it all together. Coming back to whatever your rule in your state is, or if you lodge with the ACNC, revenue is an important number because it gives an indication of size and then the rest of the responsibilities. So we've recently had some discussions with the ACNC around this because there's been some different views. You know, this is now, you know, with my real technical hat on. If we look at income of an entity, it could be revenue or it could be other income. So we were interested, if you look at the size, are we just looking at the revenue number or are we looking at the revenue and the other income? And the ACNC are making it very clear they just look at revenue. And then we've thought, okay, so it's important now to know what is revenue and what is other income. And discussions were, can you only get to revenue if you are booking the revenue through AASB 15, revenue from contracts of customers, or could you also have revenue if you go through AASB 1058, where the title of the standard is income of not-for-profit entities? So is AASB 1058 leading to other income and AASB 15 leading to revenue, or how does this work? And in conversations with the ACNC, we've clarified that that's actually not the way to look at it. So where the revenue or where the income come from, which standard you've applied, is not determining whether it's revenue or other income. What you should actually be looking at, and they've given out guidance that you can look at, you should actually look at the ordinary activities of the entity. So the ordinary activities is determined based on the source of an item. So how the charity usually raises funds. So give you an example. If a charity usually raises funds through government grants, and maybe the particular government grant meets the requirements in AASB 1058 and leads to the P&L through that part, that doesn't mean it's not revenue, because ordinarily this not-for-profit goes to government and gets government grants. Their ordinary activity is to raise money, is to raise funds through government grants. Therefore, all money that comes through government grants would actually be revenue. So I think that is really important. So I thought I might give you two examples just to clarify, because this can be confusing. So let's say we've got a not-for-profit that provides crisis counselling. It has recurring contracts with government to receive $100 for each counselling session that they provide. It also raises funds from donations and bequests. From time to time, so I put it in blue, stand out, from time to time, excess cash is invested in term deposits for a short period of time. Revenue from ordinary activities are therefore likely to comprise the $100 that people are paying for the counselling sessions, the cash donations, the property bequests, all of those things that happen on a regular basis, recurring basis. That's how we ordinarily raise money. However, from time to time, we might have some term deposits that will give us some interest income, and that is not likely to be an ordinary activity. So if we earn that interest in that situation, that interest income would be other income and will not be included in determining the size of this charity for the lodgement requirements. So another example, to be crystal clear, if we've got a charitable foundation that's been established 10 years ago with a bequest of $10 million to manage a portfolio of investments, and the income each year is distributed as scholarships. Let's say during the year, the charitable foundation sold a motor vehicle the CEO was driving, and they made a gain of $5,000 on the sale of that vehicle. If we now look at what would be revenue, revenue from ordinary activities are likely to comprise interest income on cash that we've invested, because ordinarily we invest cash. I mean, we have this big bequest that's invested, and all that interest income leads to our revenue on a regular basis. So in this instance, different to the previous example, interest income is actually revenue. Then investment income from the portfolio of investments is revenue. And if there's changes in the fair value of these investments that go through P&L, that's actually revenue. That's our ordinary activities. That's how we make money here. And then the gain on the disposal of the vehicle is something that's not happening on a regular basis. That's definitely not how we make our money, and that will be other income. So I think it's really important to articulate that revenue is important to determine your size, to determine your further obligations. Let's be very clear what is revenue and what is not revenue, because it's other income. So that's just two examples. We've also included an article on this in our November 2021 newsletter, if you want to read a little bit more about it, or to reach out to any of us to assist you, because that's an important criteria. Another change, an important one, is there's been amendments to the ACNC regulations around KMP compensation and related party disclosures. So AASB 124, the one I had in red on my earlier slide, is now a mandatory standard for entities, even if you're only preparing special purpose financial statements. So it's not just the standard 5, there's now a 6th one, AASB 124. For 30 June 2022, so for your 2022 annual information statement, your KMP, key management personnel compensation, needs to be disclosed. However, for 30 June 2022, it's only for large charities. So you're above the 3 million revenue. And if you have 2 or more key management personnel. So that's why I had it in red. It's not mandatory for everybody, but consider whether it's mandatory for you. And you only do this KMP compensation disclosure in aggregate. So you don't have to say, you know, Director A earns this, Director B earns this. You put it all together. For 30 June 2023, Anthony.
That works, doesn't it? Sorry, Aletta. Just that sort of get out clause, I suppose, only if 2 or more KMP. My observation on that, there's going to be very few, if any, that actually have only 1 KMP, because, and I think you might clarify this on a further slide as to what makes up KMP. So it's a board and the executives generally, and most, if not all, charities have a board. So, yeah.
I agree. Listen, the old-fashioned hand in the air is still working, Anthony. Because
yeah, we don't need that little yellow one going like that. That's it.
Anyway, you're right. For large charities, I just can't see that happening. However, the way they're transitioning this is they go for 30 June 2022. We look basically at large charities, and for 30 June 2023 onwards, it will be for medium and large charities. They're not forcing it onto small charities because they're not subject to review or audit or anything. So, you know, I think they're containing it to medium and large charities. So what we've also done in here, and I'm not intending to step through this in great detail, I've got a link to the KMP remuneration guidance on the ACNC website. I've given you some examples of key management personnel. So responsible people, you know, the board, committee members, trustees, senior staff, CEO, CFO, etc. And then, you know, the other thing to note is sometimes the key management personnel services may be provided through a separate entity. It could even be an accounting firm that provides a CFO in return for a fee. And that would also be key management personnel compensation and should be included in that aggregate disclosure. But if this is relevant to you, large charities, you should look at that remuneration guide. The other thing that's interesting is that AASB 124 in paragraph 17 requires disclosure of the total KMP compensation, plus they want a breakdown, you know, what is short-term, what is post-employment benefit, what is other long-term benefit, termination, share-based payment, etc. However, the ACNC Commissioner has exercised discretion that charities are not required to disclose for each category, so they just do it as a total KMP compensation. So AASB 124 obviously has wider application than just not-for-profits, but luckily the ACNC exercised the discretion to say you don't have to break it down like that. I don't think it's particularly relevant for not-for-profits. I haven't seen share-based payment compensation for not-for-profits. etc. So I can understand why the ACNC Commissioner applied the discretion. And it's an ongoing discretion, not just for the first year. So it's ongoing. Still looking at 30 June 2022, usually we have to disclose comparatives. So if we're looking at 30 June 2022 financials and we have to put in KMP remuneration, usually you need to put in comparatives. Again, the Commissioner says you're not required to disclose comparatives for 30 June 2022. However, that discretion only applies to this first year. When you get to 30 June 2023, you've already disclosed it last year, so you'll repeat it as a normal comparative disclosure. If we go to 30 June 2023, again, you know, they've said paragraph 38 requires disclosure of comparatives. So they said you're not required to disclose comparative information when applying AASB 124 for the first time in 30 June 2023. So that would be if you're a medium charity. So if you're a large charity and you've applied it in 2022, then in 23 you have to do comparatives. If you're a medium charity that do it for the first time in 23, you don't have to put in comparatives, but it's only a discretion for that very first year of application. We've also included here the point around AASB 1060 simplified disclosures. Now, traditionally, we would say simplified disclosures only applies if you're doing general purpose financials. However, the ACNC amended Regulation 60.30 to say if you're doing special purpose financials, you can apply the equivalent disclosures from AASB 1060. You know, to assist. So we've given you a bit of a summary of where you will find the equivalent disclosures. So if you look at AASB 101, I think the key thing there is AASB 1060 allows you to prepare a single statement of profit or loss and retained earnings. So not a separate statement of changes in equity. So if you want to explore that, you can look at AASB 1060. So we've given you a little bit of a summary. The other one to note, you know, AASB 1060 has disclosure requirements for key management personnel, but whether you apply AASB 124 or AASB 1060 here around key management personnel, very similar, because it's something that's important to have the transparency out in the market. So one would expect it to be very similar. Then also, this is just, you know, some additional information around how does the interaction work between AASB 1060 and special purpose financials. And I've given you some links to information. It's really important if you're doing special purpose that you clearly articulate what recognition and measurement you're doing and what disclosure you're doing. So there's full open, you know, disclosure and transparency. And I've given you some links to resources, a lot of resources available on our website to explain this because it's a new area, so please look at that. I want to quickly flag with you that ACNC have issued, you know, their best practice guide around disclosures, and they want to improve transparency and accountability. So they've got 3 recommended disclosures. If 10% or more of your total revenue is received from government, you should disclose, you know, the source of your income. So you disclose total revenue from each level of government. So whether you get it from Commonwealth, state, local council, you should disclose the amount of revenue received from each government department, and also, you know, revenue from providing goods or services to beneficiaries who receive related financial assistance from the governance, for example, through the NDIS. You also, they recommend that you disclose some potential economic dependency on government revenue, and then also funding received from government, but it's not yet recognized as revenue. And maybe under AASB 15, it will only be recognized as you perform. But again, full disclosure. So these are recommended disclosures that were added in the latest guide. that I think you should be aware of and have a look at. We've also given you a link to that guide, and we've given you a little bit of an example of what the revenue disclosure could look like. So it's a real breakdown of your revenue to make sure that we are very transparent on where we get our funds from, in order to remain a going concern, remaining to provide all our amazing services. So that's good information. The next one that I want to look at, and this is a real good news for not-for-profits. We've been talking about this ever since my favorite standard has been introduced, AASB 16, around leases. The AASB went a bit further than the International Accounting Standards Board, and they said, you know, when we apply AASB 16 to not-for-profits, and if you've got a Peppercorn lease, you're paying $1 per year for 30 years to use the property that the school is on. Not only are you going to book the lease liability at the net present value of the $1, they said you should also book a right of use asset, not at the net present value of the $1, but you should actually fair value the right to use that property. And there's been a lot of debates, you know, how do we determine that fair value of the right to use? It's different to owning it, etc. But the big problem has always been, you know, what do we do with the difference? And when you book the difference, because if we've got this big fair value of, let's say, 30 million, but my lease liability is $1, that difference of nearly 30 million, is that other income? Is it revenue? When is it revenue? When is it other income? And how does it skew the information and the P&L of not-for-profits? The AASB, very late in December, came after the standard was issued. They came up with temporary relief. They said, okay, we'll sort this out for you. You don't have to do it yet. But now the good news is the AASB has decided that that temporary exemption or temporary relief now becomes permanent. Therefore, it's included in ED 318. You can permanently keep that right of use asset at the net present value of $1 and the lease liability at the net present value of $1, nothing in income, nothing in P&L, nothing in revenue. So it's amazing news. This has been a big worry for a lot of not-for-profits, the cost involved to come up with a fair value of these right of use assets and what it does to their P&L. You know, it really has been a big issue, so we're very happy about this. It only applies to not-for-profit private sector entities. In the public sector, there's still a debate on that. It's been decided at the April meeting. I haven't seen the final standard yet, but no doubt it will be in place by 30 June 2022. Again, I've included some articles that we've written on the topic. And I know we've talked about it on various webinars. Anthony.
Just before we leave that around the Peppercorn leases, I think there is still a requirement in there that you still disclose those arrangements. So it's not as though users aren't aware that there's those favourable arrangements in place.
Absolutely. But at least we don't have to go to the length to pay a valuer. And there's been such a debate on how do you value the right to use a property as opposed to owning the property. And there's usually restrictions placed on the property. It can only be a golf course. It can only be a school. It can only be aged care, etc. Very difficult to value. And the valuers are still fighting about it. Now, Anthony, the next one is one that we've talked about a lot, and I know we've discussed it last year in our webinar, and that is portable long service leave in the community services sector. I won't look at this in detail. We've got articles where we've got worked examples on it, but I think we see this as a good thing for not-for-profits, and especially the people working in not-for-profits, you know, because we don't want people to leave the sector completely. So if you move from one not-for-profit entity and you stay in the sector and move to another entity, there's this ability in certain states, in certain sectors, this is very specific. You have to do your research whether it applies to you, that, you know, there's now this portable long service leave. So it's an encouragement for the staff to at least stay in the sector. You know, so in some states, we have this portable long service leave, for example, for workers in the construction industry, coal mining, contract cleaning, etc. So the long service leave will go with them. So that's been in place for a long time, and Victoria, Queensland, ACT, it's actually now also introduced this for workers in the community services sector. And we're hoping to see it in other states as well. I think it's a good thing to keep people in these sectors. So what this involves is usually, and we've done some research on it, it's quite different in different states, in different sectors. So I'm saying usually, and I want to emphasize the word usually it involves a contribution or a levy that an employer would pay to the administrator of the scheme. And that contribution or the levy that you pay is based on percentage of the wages of employees. And then depending on the exact legal requirements, we've seen instances where the employer could have the legal responsibility to pay the long service leave to the employees and then recover costs from the scheme. Or it could be that the employee will, when they're entitled to long service leave, claim that payment directly from the scheme. So I think what we want to warn you of is you can't assume that you don't have an employer obligation. You'll have to go and look at the legal requirements and facts and circumstances, whether the employer has the obligation to pay the long service leave or not. And I think the other thing to remember is, let's assume that I've got an employee that worked for me for 3 years, and now they move to another entity in the same state, in the same industry, and they can take their long service leave with them. At that point, when the employee leaves, do I have a remaining legal responsibility or not? That's the question. Because it's not correct to just automatically get rid of that responsibility. All right, it depends. Because the new employer now takes on an employee and they work for them for another 10 years. If they have to pay the long service leave, is their responsibility for the whole period of service? Or can they come to you for that first 3 years? Or do they go to the scheme for the first 3 years? So it's all about the scenario in your specific situation. I think it's good if it goes through the scheme, but please don't just derecognize these liabilities before you clearly understand your ongoing liability. The other thing to think about is, if I'm the employer that gets somebody and they now work for me for another 10 or how many years, do I have a recovery from the scheme, or do I have a recovery from the previous employee? How does this work? You have to understand really well how it works. And then obviously, when can we recognize a reimbursement asset? So if I'm thinking I've got the total legal liability for 100, but I'm going to get reimbursed by the scheme for, let's say, 80, I can't set off the two. I have to say legally I'm on the hook for 100, and then I can get back from the scheme 80. You keep it separate. So there's a lot of moving pieces here that I want to throw into the mix, and I think we should look at this very carefully and not make assumptions. I think, Anthony, that might be the best way to explain it. I don't know if you wanted to add anything.
Yeah, no, you're exactly right, Aletta. So, and probably that's where the advice was fine-tuned a bit last year, in that you disclose your asset and your liability separately. Yeah. So, but this certainly will over time become more material to the financial reports. So obviously when it's first introduced, the amounts are quite small, but each year the amounts, the asset gets bigger. But really, two really important points there that you made, Aletta. One, doesn't necessarily mean your provision disappears, and I'd say in most cases it doesn't. Certainly the way the Queensland scheme works, it definitely doesn't. That when it comes to paying out and whatnot, each of the states can be a little different. So you just need to be across that and then clear on how you account for that. So say from a Queensland perspective, in that scenario you gave where they go to a new employer, there's that second employer there. That employer is only ever liable for the long service leave that it would ordinarily be liable for under current workplace legislation and whatnot. So any shortfall for that, say, first 3 years of service, the employee would go to the scheme for that component. So it's pretty much, say, for a Queensland community service organisation, it is as it was before the scheme came in place, but you are now just recognising this asset for what you could potentially recover. But no, I thought you summarised that well, Aletta.
Thank you very much, Anthony. Then the next section that I want to touch on is ESG and sustainability. Now, as you all know, it's all over the paper. It's been in the election. Everybody's talking about ESG and sustainability, and it's also for not-for-profits. And I just want to be really clear. You know, we've got a whole webinar series on this, but just touch on a few things briefly. And that is, ESG is around environment, social, and governance. ESG and sustainability is not just about emissions and looking after climate change and net zero. It's a really big part of it, and at the moment the focus is on climate change, the focus is on getting to net zero, but there's a lot of other aspects. So in this slide you can see we have 8 key categories under environmental and 8 under social and 8 under governance. And if you look at social, I think that's the one where not-for-profits really have a big role to play and have amazing stories to tell around diversity and employee engagement, human rights, etc. But the point I want to make is, of the 24 categories we've got here, 8 for E, S, and G, only one of the 24 is around global warming emissions reduction. So it's an important thing, and it's in the media, and we've got COP26, and it's becoming important in Australia, but it's one of a range of things. And I think it's timely to talk about how do we address and communicate ESG and sustainability in a broader sense. Anthony.
That hand works well, doesn't it? Thanks, Aletta. Just on that, it's probably worth mentioning, we held a discussion in our office recently with some leaders in the not-for-profit sector here in Brisbane, and it was around ESG, and the start of the discussion is, what are you doing, what's it mean? And just probably worth mentioning, initially when we went around the table, the discussion was on those climate type elements within it. By the end of the discussion, there was a lot broader a lot better understanding as to what it actually means. But the really exciting part that I found was that you could see in the people that attended that from the not-for-profit sector, they could see the opportunity in it for them. So probably 2 key things. One is that a lot of these elements that we see on that slide there, not-for-profits are already measuring a lot of that in some way. So employee engagement, satisfaction of the people they're serving, and all that kind of thing, but aren't necessarily reporting it so well. So they saw opportunity in reporting that side of things better. But then the other piece around the opportunity was, okay, well, the for-profit sector is obviously affected by this, and there's more scrutiny by the community, investors and so on, as to how these for-profit organisations are performing in these areas. And potentially, if a not-for-profit can demonstrate they do well in a lot of these areas, so it's not all just financial, that for-profits might want to team up with them to help them meet their social obligations and demonstrate that, and massive opportunity. So it was really interesting with that group of people that came in. It went from what they do within their business to be environmentally friendly to actually seeing the bigger picture with it.
Absolutely. And you know, when Ashley and I speak to for-profits, they know not-for-profits do this really well, looking after the communities, and they're looking for those partnerships. You know, absolutely, I think that's amazing. And I think it's really important that I don't want to downplay the importance of climate change and that we need action there, but it's a small piece of this puzzle. And not-for-profits already do so many amazing things, and it's to communicate that. Thank you, Anthony. That's really valuable insights. I think what's interesting also is some people say, you know, we don't want to do, or we don't do things about all 24 aspects. And how do I know what to focus on? And what we are doing is working with entities and saying, let's think, who are your stakeholders? And every entity's stakeholders are different. So if you're a not-for-profit, where do you get your revenue from? Is it government? Is it philanthropists, etc.? Is it large for-profits that make charitable donations? But who are your stakeholders? And let's reach out to them and ask them, of these 24 metrics as an example, what are you interested in? What would you like us to action? What would you like us to report on, to measure? So speaking to stakeholders and tailoring your message and your reporting and your communication and your action towards that, I think is really important. So this is a bit of an idea of a stakeholder overview. And you know, Anthony, when you spoke, I heard the word opportunity. And when Ashley and I started talking about this, we said the business problem around ESG is the following, but actually, and it's maybe my oversight, Ashley, I apologize if you're listening, it's actually what is the business opportunity? We've evolved our thinking. It's not a problem, but it's also, and actually more, an opportunity. It's access to capital. So access to for-profits giving you money to do good, or access to government, or access to philanthropists. So if you do ESG well and you communicate it well, you get greater access to money, access to markets, right, to the people who want to engage with you, to customers, people using your services, but also access to people. You know, we see it at BDO, Anthony. We know that staff want to know that BDO is a sustainable business doing the right thing around the environment, diversity, inclusion, the community, etc. So if you want people to come and work in your not-for-profit to provide great services, we need ESG. It's an opportunity to attract people, but it's also to attract those people who use your services. They're comfortable to use your services because you're doing the right things, and obviously the money. So we really believe that the solution here, and remember, I'm an accounting nerd. I love accounting standards, but I am saying accounting standards and audited financial statements are not communicating all the information that all the stakeholders want. There's a gap. And I believe that gap should be supplemented or filled through voluntary ESG and sustainability reports. So how do we get to holistic or integrated communication? I think it's a combination of financial statements and sustainability reports. And it's not really voluntary. There's no regulation mandating it, but the people have spoken, your staff, your clients, etc., and also people who give you money. So I think that's really important, and I'll wrap it up quickly, Anthony, because I want to get the panel involved. There's a lot of frameworks. I don't think we should obsess about the frameworks. I think let's take it back to themes. We've come up with 24 themes. Let's speak to stakeholders and report on the themes. There's no definitive exactly what to report on everything. That's not important. Let's open the batting. Let's make a start. Let's have a baseline report. The name of the game here is improvement, continuous improvement. And in order to improve, you have to start to measure, start to report. And then there's an international sustainability standards board sitting next to the accounting standards board. They're trying to get to consistent rules, bit of interesting information. Where do we start? I've put in that Ashley and I are doing workshops with boards at the moment, and we can do it virtual, we do it face-to-face. And I know, Anthony, for example, you've got a new partner that joined on Monday this week, and he'll be able to do this. We are very happy to have workshops with boards and key management personnel, senior people, and talk about why do you have to action on ESG, and where do you start, how do you do it? It's not that overwhelming. What are the particular outcomes? So I thought I'll put it there. Please reach out to us if you want us to, you know, talk about the risks and especially the opportunities around ESG. I'll just flag with you, for 30 June 2022, the existing rules are in place on how do we decide whether a liability is a current or non-current liability. However, there's been changes to the standard. It's not effective yet, but there's been such an uproar about the changes that there's already an ED to change the changes. So I would say please don't early adopt the changes, because it's got to change again. And there's going to be changes around how do we decide whether liabilities are current or non-current. If you're interested in that, please contact me. The current rule is around, it's only, current, unless you have an unconditional right to defer settlement, you have a current liability. We've got a fantastic publication issued by BDO Global, so I can say it's fantastic. I had nothing to do with it. It is a fantastic publication by Global on what this means. But if you're worried about that and want to know more about the future, we've discussed it extensively in last month's normal IFRS webinar. And then a reminder, the director ID requirements, if your directorship existed before 31 October 2021, you have to register before 30 November this year. And then it's a good reminder for myself actually as well. And then if your directorship started between November and April, within 28 days of appointment. So it's just more a governance reminder, and we've got some articles on that. If you need assistance on the accounting matters, we've grown to about 6 leaders across Australia, so Melbourne, Sydney, Brisbane, Adelaide, Perth. So please reach out to us. You can always reach out to me. And our team is also growing. Accounting is becoming even more exciting. And we now have ESG people in the team as well, which is super exciting. But I want to go over to the Q&A with the panel. So Anthony, I think we invite the panel members to join us. Yep. As you said earlier, it's the 2 of us and then the interesting people, Elizabeth and Leah, Ashley and Oliver. I'll take the slides away so we can see them nice on the big screen. Let me see if I can do that. So stop sharing. I'm hoping I've got that right. Stop showing my screen. I'm hoping you can no longer see my screen, Anthony and panel members.
Worked.
Oh, it worked. It's always good if Aletta can get technology to work. My kids will be very impressed. I can still not switch on the television, but right, there's too many buttons to press for this television, right? Anyway, but I can do go to webinar. All right, so welcome everybody. Thank you very much for joining us today to bring some excitement to an accounting webinar. I thought I'll kick it off. All of you have not-for-profit clients, and I'll ask, what are the topics that the boards and senior management at the not-for-profits you deal with are talking about at the moment? What are they talking about? What are they thinking about? Leah, can I maybe start with you?
Thank you, Aletta. Yes, boards are discussing a lot of topics at the moment. One of them links in with, I think, Oliver, where they're talking about the excess cash that they have and how should they be best utilising that cash given the interest rates at the moment are low, but then also dealing with the risk or the volatility that comes with other investments.
All right, fantastic. Oliver, did you maybe want to expand on that? While we're at it, we'll get to the other issues shortly.
Yeah, sure. Look, both of those points are the reason why we're seeing lots of not-for-profit clients at the moment. Low interest rates, and I think also a big surplus of cash that has come from COVID as well. A lot of stimulus was provided to not-for-profits, which is fantastic. And previously, not-for-profits, like you said in your presentation, Aletta, a lot of rolling TDs and in combination with donations and other activities that was able to keep them going. Then interest rates went to next to nothing, and they had much more cash to invest, so they came to us. Now, not-for-profits differ from our for-profit clients because their investment process, it needs to be held to a higher standard, because they're effectively the fiduciaries of their members' funds, their donors' funds, and it's actually going towards a charitable purpose. So whilst we are very good at doing the investment piece, we said, let's take a step back and look at the framework that you're working under and get a good governance process so that you can go to your members and say, we have actually done this properly. We've looked at our ESG concerns, we've looked at our risks, and we're not just out there speculating with money that's not actually ours. So I think that that piece, first of all, we need to really understand the organisation. That's the first step. What is the objective of the charity? What are we trying to achieve? Because that will eventually flow into what investments can we use and how much risk can we take on. So that's really about determining the time frame. Like running a fund for a school foundation, an endowment fund, would be very different to a private ancillary fund, for example. And then the next step is education for the board, so they really understand the investments that they're getting into, and also the investment policy statement. So this statement is really what puts that objective into writing, and the board needs to be comfortable with that to say, this is how many shares we have, this is how many short-term bonds we have, and this is how we've invested within our sustainability framework as well. You know, we can say we try not to invest in coal, or we can invest in impact funds. And I think with the volatility that we've had recently, those clients that we talked to last year that we educated on the type of investments they were going into, often after we had this discussion, it would result in, okay, well, let's not put it all into the market now. Let's drip feed it in over the next 12, 18 months, because that's how much risk they were comfortable with. So because they had that framework set up, now they're experiencing this volatility. We're having phone calls with them. They actually understand why the market is doing what it is and why their fund is doing what it is.
It's interesting what you say with that framework, Oliver. One of my observations is amongst the not-for-profits that are lucky enough to have a good amount of funds under investment is that they do a lot of that work a number of years ago in setting up that framework. And then it might run for a number of years, and people start to lose sight a bit of what they set out in that framework. And we'll go in and remind them to say, be reporting back against that. So it's not a set and forget exercise at all, is it?
No, and you do really need to keep on top of it, because markets change, expectations change. The bond markets are very, very, very different to what they were 5 years ago, just as one example.
And I think then charities have the question of when do they start dipping into their investment funds to start using it for new initiatives or covering working capital. So it can be linked into sort of reserve policies, etc. What working capital is actually needed.
Yeah, and sorry, Aletta, just within that investment policy statement, one thing charities can do there is they can set buckets. So if you've got funds needed for different timeframes, you can have specific buckets to try and achieve those different objectives.
I think we're talking about at the moment, you know, not-for-profits who have a lot of cash after COVID or have always had a lot of cash and the things they're concerned about. I'm just wondering, surely there are those not-for-profits that are not cash rich at the moment. So do we have an issue on the other side as well? Are you seeing some pressures on the other side as well, Leah?
Yes, I have had a number of charities actually reach out and say, how can they prepare for year end? What are we going to look for when we're looking at going concern, and their ability to fund their debts as and when they fall due? So each of them need to look at their cash inflow and outflow expected for the next 12 to 18 months. But if they've got the ability to get bank borrowings, and some do because they have assets that they can borrow against, then having that in place before June year end is fabulous, or at least before we sign, then we can reference that. They might still need to have an emphasis of matter in their in their audit report, but it's great if they can start thinking through what are their needs going to be for the next 12 to 18 months.
Yeah. So I'm asking a silly question as an accounting professional and not an auditor. What are the level of documentation that you guys would be looking at around going concern? And I know you have to do it when you sign. It's not 12 months after year end, it's 12 months after you sign. But generally, if I can throw it maybe to Anthony and Elizabeth, what are the documentation that you would like to see? I know it's all about being documented, right? But what in practice, what do you look at?
I'll let you go, Elizabeth.
Sure, thank you. Yeah, so we're looking at budgets and forecasts and what reserves does the not-for-profit have in place, and are those budgets and forecasts, are they achievable? So what are the plans for the future 12, 18, even 24 months? We can't just stop, like Aletta said, from the date of signing. But also I think in regards to going concern and expenses are increasing, the Great Resignation is impacting not-for-profits heavily. It's impacting every organisation that we have any dealings with, and people are also they're either moving or they're wanting higher salaries in line with inflation, and we're seeing that the grant contracts are not reflective of the rising costs that not-for-profits are experiencing. So it is a really challenging time.
Yeah, and I think that's exactly right, and we're seeing exactly the same. And so then when it comes to that forecasting, and they're forecasting out payroll costs, say that they are considering the tightness in the market and what the increases are that are coming through, that's properly reflected. And also, if they are heavily reliant on grant funding, well, have they been having discussions around renewal? How likely are grants to be renewed or increased? They're the kinds of things that we're asking when we're testing that cash flow forecast.
I would say, as maybe from a governance perspective, you know, in times when there's a lot of cash available and when offices and the services we provide, if we spend a lot of money, it's good because we're helping a lot of people. However, is it not from a governance perspective also having controls in place to make sure that, you know, when you go over certain thresholds, you get approval. When you go outside your budget, you get approval. Because it's very easy, I think, in today's day, that expenses run away with you. And unless you are in the fortunate position that you're very cash rich, that can be a problem. So those controls, not just on fundraising, but on expenditure, and then also the governance structure around the investment policy, it all fits together, right? You have to manage your spending, but also make sure you do fundraising and invest wisely.
And Aletta, I think it's also everyone understanding what each program is costing, because a number of charities have so many different activities and they've got great ideas and are doing wonderful work, but there are some pieces of that work that are losing money, which can put the whole organisation at risk. So it's really critical to have the accounting systems and processes in place to capture what the cost is of each program, so true, like accurate decisions can be made.
And Aliyah, I've been involved in a not-for-profit as a board member, and what I've seen is it's also important to know the difference between restricted and unrestricted funds. You know, because if we have a lot of restricted funds, you know, how are we paying our head office costs? And, you know, do we build into, when we apply for government grants, do we build in an appropriate percentage to be allocated to be paying, you know, head office staff and program managers, because otherwise the not-for-profit can't survive, right? So I think that's another overlay that we see in not-for-profits.
Agree.
Yeah. So Elizabeth, what are you seeing? What are your not-for-profits talking about? What's the #1 concern at the moment?
Well, I think it's staffing, because in addition to there being turnover, organisations that are unable to deliver on their programs because they just don't have the staff available. So staffing is a key one, and also the uncertainty of investments. Where is the market going? And I think a lot of 30 junior ends are expecting some large losses for this financial year.
Elizabeth, so the consequences of not delivering the services, obviously, not-for-profits, and I know people in not-for-profit entities are passionate about helping people. So the consequence, if we don't have staff, is we can't provide the services. Yes, and that's catastrophic. But there's also financial implications, and there's implications on financials, right? Because if you don't deliver all the services, but sometimes you have to give the money back. Hopefully your grantor will say you can keep it and spend it next year, but that's not automatic. And then also it has an impact on your profit and loss, right? If you only recognize revenue as you provide the services, if you haven't provided the services, there might not be revenue.
That is correct. That is correct. And also on the flip side, there might be grants that are received that are not enforceable. They're not sufficiently specific. So the not-for-profit is looking very healthy from a cash perspective, but there's all these programs that still need to be delivered on. So the financial statements may not show a true reflection of where the organisation is sitting.
And I'm thinking Ashley is saying, are you telling me financial statements are not telling the whole story? Really, Ashley? They do need additional reports, don't they, Ashley? What are you seeing with not-for-profits?
Well, I feel a little bit jaded, Aletta, because you stole my thunder earlier on when you talked about the role of ESG in corporate and not-for-profit areas. But it's interesting from my perspective. So I'm obviously doing a fair bit around ESG and sustainability. And what is happening, obviously, is there is a significant increase in the amount of activity from corporates and organisations generally in relation to ESG and sustainability commitments. As recently as this morning, we were just talking to a not-for-profit client, and I was saying, rightly or wrongly, I see this as one of the greatest opportunities for the not-for-profit sector to improve their ability to deliver services. And Anthony touched on this earlier, and the reason is because the vast majority of organisations in Australia haven't really done much in and around ESG, and to the extent that they have, they focused on E, the environment, not so much S or G. When they get to S, they think about, well, how on earth can we actually, and just to reiterate, S is about how do we interact with the community, right? How do we interact with our employees? How do we interact with our customers? How do we interact with our supply chain? And how do we interact with the communities on which we rely for our model to prosper? And it's that last bit that they're really struggling with. How do we support communities that we rely on to prosper? And often what corporates do is they say, okay, well, you know, our employees do X amount of volunteering per year and our donations register looks like this. This is the amount of money we give. And then it stops there and they can't really go any further. I think what the astute not-for-profits are doing is they're saying, hey, we can solve your commitments you're making in and around S because we can deliver some of the programs that you wanted to deliver to the communities on which you rely. And I'm sure I've talked about some of these examples before, but the classic one is, you know, some of the big commercial property owners around Australia, the vast majority of their asset base by value is in CBDs. And so they say, look, we know that some of the key social issues in and around CBDs are things like youth at risk, homelessness, and then maybe also other things like natural hazard issues. And so they're trying to partner with social enterprises or not-for-profits that deliver on programs in relation to those types of activities. Another example, a not-for-profit that is delivering much needed surgical training and programs in developing countries is looking to partner with corporates that have some kind of interest in supporting those communities. Now, whether that be medical products organisations or otherwise, there's a real opportunity for them to start to improve the health of their balance sheet and their P&L by building stronger, more relevant partnerships with these organisations. And it's not necessarily intuitive, right? So one example might be take Toll, right? Big ugly trucking company. Toll, in one of its community partnerships, has what they call a hauling safety program, and they're all about safety on roads, right? They support 2 schools in Thailand because in Thailand, traveling by motorcycle is a common way for parents to take their kids to school. And I don't have the exact numbers, but thousands of children and teenagers die each year from road crashes. And so Toll is partnering with an organisation that delivers this program in Thailand for them. Now, I don't know whether Toll came up with it themselves, or I don't know whether this was an astute organisation that went to Toll and say, hey, we've got this road safety issue. We want you to support us to deliver this training. And so for me, there's a real opportunity here for not-for-profits to benefit from this huge explosion in ESG activity as corporates look to actually execute on the commitments they're making in the social space to support communities more broadly.
Absolutely. Thank you very much, Ashley. Anthony, lucky last, what are your not-for-profit clients talking about? I'm hoping there's something in addition to everything we've already covered. You've got the difficult spot.
Yeah, no, that's fine. I'll definitely reinforce what Elizabeth's observations were. They're certainly coming through loud and strong, and fundraising is difficult, has obviously been difficult the last few years. Looking to diversify revenue streams is a big issue that a lot of them are trying to achieve, and less reliance on government. But probably one thing, and to be honest, it's not generating a lot of discussion, but I think it is on people's minds, or it should be, is around the self-review for tax purposes. So the government announced a little while ago that not-for-profits will be required to submit a return post 30 June 2023. That's basically their self-review assessment to make sure that they are still income tax exempt. Now, those registered with ACNC won't have to do that, although there is that requirement that really they still meet fit within the bucket that they are income tax exempt. But what my recommendation is to not-for-profits, what they should be doing now in preparation for lodging those self-review forms is relook at their formation documents, their constitution, be absolutely clear, this is what the purpose is that's set out in our constitution, and then look at all the different elements within their business and make sure it's consistent with that purpose, because that is one of the requirements to being income tax exempt, that everything is done for that purpose. So look what you're saying on your website, what's reflected through your financials, what's coming through in the minutes, like all, because these businesses, and they are businesses, do develop over time, and there might be elements that think, okay, well, is this really in line with that purpose? So that's a good thing to get ready for that when it comes in a few years' time.
Aletta, sorry, I was just listening to Anthony and Elizabeth. Can I just think out loud here? And this might be a stupid idea, but I think, in terms of working smarter, not harder, if a lot of these issues are common to a lot of not-for-profits, take staffing, right? We have a staffing issue at BDO as well, right? Like we would love to be able to get more people to deliver better services to clients generally, but we can't. And so we're trying to think of ways to solve it. And so we're trying to invest in technology as a way to generate more efficiency in the way we deliver services, because we just can't get more people to do it. I wonder whether, if this is an issue for not-for-profits as well, and Elizabeth says it is, and this has catastrophic consequences, right? If you can't deliver your programs because you haven't got the people, then your whole business model stops working. I wonder whether there's an opportunity, and I don't know the answer to this, to think about partnering with corporates that could improve the efficiency of your business as part of their social commitment if they have an ESG commitment. Now, we always default to automation of processes and digital efficiency when we think about efficiency improvements. Doesn't always have to be, but I don't know, for example, I don't know what Microsoft do around community support programs and, you know, efficiency benefits through a lot of the kind of technology they've got, and there's be a bunch of other technology companies as well. But if this is a real issue in some not-for-profits, and if they can identify areas where they can improve efficiency so they don't have to worry about staff shortages, they might get better outcomes by partnering with corporates to help them deliver on their programs.
You know, Ashley, I think it's actually a good idea, even if you think about different not-for-profits potentially run programs in different countries. So there's a lot of not-for-profits running similar complementary programs in these countries at great expense, program officers, etc. And I think the whole idea of partnering is a good idea, whether it's with other not-for-profits, whether it's with corporates, but thinking about that broader collaboration piece, interesting. Listen, we only have a few minutes left. Leah, the one thing that you and I talked about earlier is the whole KMP disclosures, and I know it's always a sensitive thing whether it's a for-profit or not-for-profit. And I think you've said to me that that new change to disclose, you know, key management personnel remuneration is one part, but there's another part which maybe I haven't clearly articulated back to my webinar.
Yeah.
The fact that you have to disclose transactions with related parties, and that your key management personnel or director is a related party, and that this is potentially covered just not one way but both ways. Do you want to maybe expand on that? I thought that was really interesting.
So a number of not-for-profits strongly encourage their directors to donate, or they choose to donate themselves because they believe in the cause. And should this donation be included in the related party transactions list? And I think at BDO we've assessed now that it should be, but it doesn't need to be included with individual names attached to the individual amount. It can be amalgamated into one amount, uncovering all the directors.
Yeah, and I was also thinking earlier, when we look at the ACNC disclosure recommendations, Leah, as soon as you get to some level of economic dependency from government or anybody, that is obviously a good disclosure to make. So I'm not saying that not-for-profits are dependable on or have economic dependency on donations by directors, but it could potentially happen, and therefore it's also a big risk to disclose, right? So I think it's throughout, it's that whole theme of transparency.
Yes, exactly.
So I think we've run out of time. It is so lovely of you to invest your time to come and speak to our not-for-profit clients. I really appreciate it. And I think we'll call it a day there. Oliver, thank you for sharing your insights around in the governance, specifically around investments and managing the excess cash. Our audit partners, good luck for reporting season. Please help our auditors, our audit clients along the way, going concern assessments. Ashley, I think you and I continue on our great journey on ESG and sustainability. We'll have another similar webinar where we talk about not-for-profit issues in November, and we hope you can join us then again. Anthony, did you want to say some final comments, or happy for us to?
Happy to close, but thank you, Aletta. Wonderful once again. So thank you.
Thank you, everybody. Have a wonderful day.
Thanks, Aletta. Goodbye.
Thanks, everyone.